G'day Gain Squad, the global markets just pulled a total UI that's about to blow your portfolio wide open. We've had a massive 16% crash in oil that sent the smart money running for the exits in a proper panic. Today we're unpacking the Middle East ceasefire drama, the sudden crash in crude, and the massive tech stock swings. We'll also deep dive into why AI is making gold, silver, and copper more essential than your morning flat white. And stick around to see if these metals ratios are signaling a proper golden entry for the long-term gold getters. Before we optimize this entry, remember I'm a Sydney-based trader, not an advisor, so do your own research, okay? So here's the big question. Is this ceasefire the end of the gold rally, or is it just more room in the pouch? Chuck your thoughts in the comments, tap that like button, and subscribe to keep your gains golden, traders. Right, let's get into it. The Middle East ceasefire hit the newswires late on Tuesday, April 7th, 2026. Pakistan and Oman brokered a 2-week truce between the US and Iran, and the market reaction was wild. On Wednesday, April 8th, the world breathed a sigh of relief, but the peace felt a bit shaky from the start. Israel wasted no time, launching over 100 strikes in Lebanon within hours of the announcement on Wednesday. They claimed they were targeting Hezbollah, but it sent the fear index of the market into a proper wobbler. By Thursday, April 9th, the death toll in Lebanon topped 300, and the ceasefire looked like a thin slice of ice. Iran was fuming, calling the strikes a total breach, which kept the geopolitical risk premium from fully evaporating. Donald Trump was out there calling Lebanon a separate skirmish, which didn't exactly calm the nerves of the smart money. We're seeing a massive interpretational gap where one side thinks the war is over and the other is just getting started. For us gold getters, this means the safe haven bid isn't dead yet. It's just taking a very stressful breather. Now, let's look at the oil market, because West Texas Intermediate, or WTI, had an absolute shocker on April 8th. WTI opened at a massive $108.74 per barrel on Wednesday morning. By the time the afternoon rolled around, it had plummeted 16.41% to $94.41. That is a massive one-day drop that wiped out the Hormuz risk premium in the blink of a tech-savvy eye. The OVX, which is the Oil Volatility Index, was screaming at nearly 99 points before the news hit. It dropped 15% to 83.91 on Wednesday, as the panic selling started to settle down. On Thursday, April 9th, oil tried to find its feet, closing slightly higher at $98.64. But by Friday morning, April 10th, the price was steady around $98.57 per barrel. The market is basically paralyzed, waiting to see if tankers can actually get through the Strait of Hormuz without trouble. If that toll booth Iran setup stays in place, we could see oil bounce back toward the $100 mark real quick. While oil was crashing, the Magnificent 7 tech stocks were out there having an absolute ripper of a session. On Wednesday, the ceasefire sparked a massive risk-on move that sent the big US tech giants flying high. Amazon led the pack, surging 5.43% to $233.26. Meta Platforms wasn't far behind, jumping 2.63% to $628. Nvidia, the king of AI chips, climbed 1% on April 9th to trade around $184. Even Tesla found some love, adding 0.63% to reach $345.40. It seems the smart money is rotating out of defensive plays and straight into the tech names that drive the future. Alphabet also joined the party, with its Class A shares rising 3.88% on Wednesday. These mega caps are now making up nearly 40% of the SP 500, which is a bit of a worry for some. But for now, the AI momentum is too strong to ignore, and the ceasefire just gave them a fresh excuse to rally. Speaking of AI, let's talk about why the physical infrastructure for these systems is a goldmine for our metals. We're not just talking about software, we're talking about massive data centers that are absolute copper hogs. A single large AI data center can require up to 50,000 tons of copper for its electrical and cooling systems. JP Morgan expects data center demand for copper to hit nearly 500,000 tons annually by the end of this year. Every megawatt of capacity needs about 5 tons of copper, and the world is flat out trying to build them fast. Silver is also a secret weapon here, because it has the highest electrical conductivity of any element on the planet. It's essential for the circuit boards and high-speed connectors that keep AI models from having a proper meltdown. The Silver Institute is predicting a massive supply deficit of 150 million ounces for 2026. We're seeing a world where industrial demand for silver is hitting record levels, taking up 60% of total supply. And gold isn't just for jewelry. It's used in high-end connectors to prevent oxidation in those multi-billion-dollar servers. Let's do a deep dive into the semiconductor stocks because the competition is getting properly fierce in Sydney time. Advanced Micro Devices, or AMD, is chipping away at Nvidia's lead with its new $60 billion deal with Meta. This agreement covers AI chip supply for the next 5 years and could even give Meta a 10% stake in the firm. AMD shares have been an absolute rocket, up 88% over the last year compared to Nvidia's 46%. But Nvidia is still the heavyweight champ, reporting $68 billion in revenue for their last quarterly update. Their gross margins are sitting at 75%, which is basically printing money in the tech world. However, we saw a sell the news event on April 8th, where the sector pulled back slightly after a massive run-up. Smart money is starting to ask if the high levels of investment in AI infrastructure are actually sustainable long-term. Memory chip shortages are also starting to bite, with Samsung and SK Hynix planning to hike prices by 70%. This seller's market in memory is a huge tailwind for the semi sector as we head into the middle of the year. Now, let's look at the SOX, the Philadelphia Semiconductor Index, to see how the broader sector is holding up. On Monday, April 6th, the SOX was trading at 7,916 points, a solid 1% gain. By Wednesday, April 8th, it had surged to 8,510 points as the ceasefire rally took hold. That's a massive move of over 500 points in just 2 days, reflecting the intense demand for chip makers. On Thursday, April 9th, the index kept the momentum going, closing at 8,647 points. This index has delivered a massive return of over 138% over the last 12 months. It's consistently outperforming the SP 500, showing where the real growth is in this cycle, traders. We're seeing a total transformation where chips are becoming as important to the economy as oil used to be. But keep an eye on that volatility, because when the tech sector has a wobbler, it usually drops fast and hard. For now, the buy the dip mentality is alive and well among the gold getters in the semiconductor space. Time for some ratio talk. Let's compare gold to oil to see if one is looking a bit too pricey relative to the other. On April 8th, with gold at 4,711 and oil at 94, the ratio was about 50-1. Historically, a ratio above 25-1 suggests that gold is expensive or oil is properly cheap. With oil crashing 16% in a day, the ratio spiked, making gold look like a massive luxury compared to crude. This usually signals that either oil needs to bounce back or gold needs to cool its heels for a bit. Given the ongoing Hormuz tensions, the smart money might reckon oil is the one with more upside room in the pouch. It's a classic case of the energy-gold disconnect that we often see during these big geopolitical pivots. If the ceasefire holds and oil stays low, gold might face some downward pressure as inflation fears subside. But if the strikes in Lebanon escalate, both could go flying back toward their record highs in no time. Keep your eye on this ratio. It's a ripper indicator for when the market is getting a bit too emotional. Next up is the silver to gold ratio, which is one of my favorite ways to see where the value is hiding. Right now, with gold around 4,652 and silver at 72, the ratio is 64-1. This means you need 64 ounces of silver to buy just one single ounce of the yellow metal. Historically, when this ratio is above 80, silver is a bargain, and when it's below 50, it's getting a bit rich. At 64, we're sitting in the neutral zone, which suggests the market is fairly balanced between the two. However, silver has been much more volatile lately, with a massive 144% gain over the last year. Silver is basically gold on high octane, so it's going to swing a lot harder when the ceasefire news hits the tape. If you're a gold getter looking for more beta, silver is usually the way to leverage the move in precious metals. But be careful, because when the market has a wobbler, silver tends to lead the way down to the bottom. I'm personally looking for this ratio to compress further if the AI demand for silver really starts to kick in. Let's not forget the copper to gold ratio, which is the ultimate Dr. Copper indicator for economic health. On March 31st, 1 ounce of copper was worth about 0.000074 ounces of gold. That's a tiny fraction, but it tells us a lot about whether the world is in fear mode or build mode. A rising copper to gold ratio means the economy is firing on all cylinders and people are building data centers. A falling ratio means people are scared and they're huddling in the safety of gold bars and treasuries. Copper hit $5.74 per pound on April 9th, holding its ground despite the dollar strength. This shows that the structural demand from electrification is providing a massive floor for the red metal. Some analysts are calling copper the new gold because it's becoming a strategic asset for national security. If the copper to gold ratio keeps climbing, it's a signal that the global growth story is still a proper ripper. It's a great way to see if the smart money is feeling brave, or if they're just looking for a safe place to hide. We also need to talk about de-dollarization and the US dollar index, the DXY, because it's been a wild ride. The DXY closed around 100 points on April 8th, trying to break out of a long-term downward trend. Positioning against the greenback is at a 14-year record low, which makes it ripe for a massive short squeeze. But the big story is China and Iran moving away from the dollar with this new yuan toll booth in the Strait. Ships are literally selling gold to get the yuan they need to pay their fees and get through the Hormuz blockade. This gold for oil trade is a massive new paradigm that could send the gold price to the moon long term. We've seen $82 billion in US Treasuries leave the New York Fed's custody in just a few weeks. If countries keep dumping dollars for gold, the mythical day of reckoning for the buck might actually be here. Let's see where the smart money is flowing. Gold is currently caught in a tight range between the big levels. The price action on April 10th shows gold hovering near $4,818. We've had a death cross on the daily chart, where the 50-day average fell below the 200-day line. But the hourly and weekly charts are still flashing buy signals, suggesting a near-term bounce is on the cards. Major support is sitting down at $4,543. That's the golden ratio. If we can break back above 4,856, the bulls will be back in the driver's seat. The market's having a bit of a wobbler with all this ceasefire news, so keep your stops tight and your eyes peeled. This is a proper golden entry if you believe the geopolitical stress isn't going away anytime soon, traders. To wrap up, we saw oil crash 16% in one day on April 8th as the ceasefire news hit the wires. Tech stocks in the Magnificent Seven surged as the risk-on trade returned, with Amazon and Meta leading the way. But the ceasefire is fragile, with Israel continuing heavy strikes in Lebanon and Iran calling it a total breach. AI infrastructure is creating a massive structural demand for copper, silver, and gold that won't go away. We've analysed the ratios. Gold to oil is high, silver to gold is neutral, and copper is holding its strategic value. The US dollar is facing de-dollarization pressure, but is still managing a cheeky short squeeze on the indices. And gold technicals are in a standoff, waiting for a clear break above resistance or a test of that fib support. So, Gain Squad, do you reckon the ceasefire holds and gold pulls back, or is the war about to flare up again? Let us know in the comments if you're buying this dip or waiting for a clearer signal from the Middle East. Make sure to like and subscribe to Goldie Gains so you never miss a beat when the smart money starts moving. Keep your positions tight and gains golden. I'll see you at the next close. Cheers!